Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based in our Manchester office, and this week I'm pleased to be joined by our regular podcast guest, Richard Carter, Head of Fixed Interest Research, and Will Howlett, one of our equity research analysts covering financials. Good morning to you both. Richard, turning to yourself first. So coming back a few weeks, actually now, we had some more positive inflation data out of the UK. And then last week, the Bank of England raised rates by a further 25 basis points, taking the base rate to 5.25%. And 6 of the members of the Monetary Policy Committee voted for that 25 basis points, 2 voted for a 50 basis points rise, and 1 actually voting for no change. So sterling initially fell, but regained some of that during the day, and gilt yields did drop slightly, particularly at the shorter end. So the Governor of the Bank of England described the conditions for their monetary policy as restrictive. But given the split in the vote, there does seem to be some differences of opinion. So what were your takeaways from the decision? And do you think the Bank of England will proceed with 2 further hikes by the year end as priced in by the market?
Yeah, they're probably not quite done, although let's hope that they are near to the peak. I mean, I'm not really surprised that there's a bit of a split of opinion. I think if you think about it, they've already raised rates, pretty aggressively, 5.25, as you say. There are increasing concerns that, about the dangers of potentially over-tightening and tipping the economy into recession. So you could see why some members kind of want to err on the side of caution, but then at the same time, inflation's still a little bit high for comfort. So I'm not surprised at this stage to see a bit of debate, and probably that's healthy. But I think, I think going on to your earlier question, I think yes, they've probably got a little bit of a way to go before they finish. Hopefully 5.75 will be enough. Maybe it'll be, maybe even be a bit lower than that. But it doesn't sound like they're anywhere near getting towards rate cuts at the moment. I think that'll take a little bit of evidence that the economy is slowing more than they expect before we see that. Because I think obviously if they keep rates at these levels for some time, it will potentially tip the economy into a difficult situation, given the pain on mortgages. So hopefully, as I say, we won't be at these sort of level of rates forever.
That's great. Thanks, Richard. And just sticking with the topic of the Bank of England, so the former chair of the Federal Reserve, Ben Bernanke, has been appointed to review the Bank of England's forecasting model. Things seem to have gone a little bit awry. So Bernanke was chair during the global financial crisis, and in 2012 oversaw the introduction of the Fed's dot plot, which tracks the views of all of the Fed voting members and how they see interest rates panning out. So could you just talk us through what did actually go wrong with the Bank of England's forecasting model, and why does it need to be looked at?
Well, I guess that's up for Bernanke to find out, really, and I think he'll report his conclusions next year. I mean, I'm a bit suspicious of this. Central banks sort of, forecasting models have gone awry, so they call in sort of one of the world's most famous central bankers to sort it out. I think maybe they need more of an external view than the sort of ex-chair of the Fed. We'll see. I mean, I think the problem sometimes with these models is that they work nicely when it's a sort of calm and sort of predictable situation. But the Bank of England's had to face, I guess, 3 main shocks that have completely tipped them and to be fair, a lot of other people completely off balance. And that's, it's obviously sort of what happened with COVID and the sort of ramp up in QE. You also had Brexit, and then also obviously the war in Ukraine. So I think they're not alone in having been completely caught out by this. And we'll see if Bernanke can get to the bottom of it. But as I say, a lot of people have been completely caught out by this rise in inflation.
Yeah, fair enough. They're not alone in that. And then further economic data out at the end of last week on Friday, we had the non-farm payrolls showing that employment in the US was a little bit weaker. So adding 187,000 jobs, consensus was at about 200, and we had previous months' figures revised down. So dollar did weaken slightly, and that helped sterling to recover some of the day's previous losses. And as we've highlighted quite a lot, the labour market has been quite resilient in the face of that tightening cycle from the Fed. And that's another data set which helps to support the soft landing narrative. So the next decision we won't have until the 21st of September, which means there will be more data along the way to help assess the impact of the policy tightening. So similar to the question regarding the Bank of England, so where does that leave the Fed now? Do we think that they are done?
Yeah, there's a good chance that they're done. I mean, as you say, these payroll numbers did play into the currently kind of very popular soft landing narrative. You've got inflation coming down. It's only around about 3% now in the States, and some signs around the margin that the labour market is weakening. So, we'll see. I mean, perhaps they might have to do one more. I don't think it would completely derail markets or anything if they did end up doing another 25 basis points. But hopefully that's it for now. And then it'll be a question of seeing, how if the economy weakens or if it's proves to be a lot more resilient than people had been expecting. And whatever happens with that will determine whether we get sort of interest rate cuts next year or whether the Fed's on hold for some time to come. But I think for now, even if they're not done, then the risk of sort of one more hike, as I say, is not exactly going to be a massive disaster for markets.
And just tying in again to the US, so somewhat out of the blue, the ratings agency Fitch decided to downgrade the credit rating of the United States last week, citing the government's growing debt burden over the coming years, erosion of governance standards, so relating to the debt ceiling standoff we had earlier on in the year, and then highlighting the risk of recession from the Federal Reserve's policy tightening. So whilst it may grab headlines, do you think it's consequential? And can you just talk us through maybe the market reaction, and does it mean anything going forward?
Of itself, I wouldn't say. I mean, it was interesting, a bit of a surprise to say. Of itself, I don't think it really matters that much in the sense that people will still buy US Treasuries, whether they're AAA or AA plus, and it's people cast their minds back some time ago. S&P did the same thing some time ago, and US Treasuries are still extremely liquid and safe, and people will continue to buy them. But it does kind of speak to the kind of wider issue of rising deficit. They've got much higher interest rate costs. Their tax take has been a bit disappointing. Aging population means there's be a lot more spending on health and social security. So there are some concerns, what that will lead to, and obviously if you were to see sticky inflation as well, potentially, staying at sort of 3+, that could lead to higher US Treasury yields. But I think for now it's more of a medium-term concern rather than anything we should get too worried about at the moment. I think ultimately, people will buy US Treasuries even if the sort of the supply is pretty high in the short term, and I think ultimately yields will be affected more by what the Fed's doing and what inflation's doing rather than what rating agencies are saying.
That's great, Richard. Thanks for all of that. Turning to you, Will, one sector that does benefit from a higher interest rate environment are banks. So we're in the midst of results season. We've had most of the major banks report from both sides of the Atlantic. However, one interesting theme does seem to be that there's that differential between the financial performance of the UK domestic banks, so the Lloyds and NatWests of this world, and then those that have significant Asian operations, so HSBC or Standard Chartered. So can you just talk us through why you think we might be seeing those trends?
Yeah, morning. Yeah, we've just been through the second quarter results for the UK banks over the last few weeks. And I think a big difference that we're seeing between the UK Asian banks and the UK domestic banks is around net interest margins. So net interest margins, the difference between what banks earn on their assets, so loans and securities, and what they pay on their liabilities, so depositors and other funding. And so for both the UK Asian banks, HSBC, Standard Chartered, you saw net interest margins expand in the second quarter, Q on Q and year on year. But it's been a bit of a weaker message at the UK domestic banks. So both Lloyds and NatWest margins still up significantly year on year, but down sequentially relative to the first quarter. You also saw both NatWest and Barclays guiding down on net interest margins for the full year. So there's a huge number of factors that can drive net interest margins. But I think a key factor has been just the pressure that we've been seeing from the UK press, politicians, regulators, for banks to pass on the rate hikes that have come through from central banks to their depositors. So that's good for savers, but bad for bank shareholders, if I'm generalizing. I think the other big difference that you've seen is that loan growth has been stronger at the UK Asian banks, whereas it's been pretty sluggish for the UK domestic banks. So, for example, look at Lloyds, where the loan book shrank by 1% in the first half of the year. I think that's the longest term story is better for the UK Asian banks. They've got stronger growth than the UK domestic banks, given the structural tailwind from Asian economies, growing wealthier. I think at the moment as well, there's a lot of uncertainty around where the UK economy heads, given the inflation picture is worse, and the debates around the Bank of England and what they do with rates. So the UK economy kind of stagnating versus some better growth in some of the Asian economies means that loan growth will be better for the UK Asian banks. And that's all feeding through to earnings estimates. So they're going higher for the UK Asian banks, and there's been a little bit of pressure for the UK domestic banks as well. So where earnings estimates go does tend to feed through to share prices, and that's certainly what we've been seeing over the last month or two.
That's great, really helpful. We'll try and put that into context and explain the differential. And then another area of financials under your coverage is the alternative investment asset managers. So just to give us a bit of a background as to what those companies do and maybe some examples, and again, linking into the recent results we've seen from the subsector, it does seem that despite there being quite attractive rates available on kind of bonds, cash and cash equivalents, fundraising by these companies has proved quite resilient. So can you just try and explain why that might be?
Yes, if you think of the traditional asset managers, your typical long-only equity fixed income managers investing in public markets, the alternative managers, that's kind of an all-encompassing term to capture just about everything else. So within my coverage, I look at the fund managers that invest in private equity, for example, or private debt. So there's companies like Intermediate Capital, Partners in Switzerland, Ares in the US. As with any fund manager, it's all about delivering investment performance. So in the case of private equity, a manager will buy out a business and then look to grow earnings and eventually sell the business to realize a return. So they might look to grow earnings by making the business more international or adding scale through an M&A strategy. And typically, these alternative managers will raise long-term funds. So it might be, say, a 10-year fund, and the institutions that provide the capital for these funds, so think of pension funds and sovereign wealth funds, for example, are then locked in for the duration of that fund. So there's no redemption risk, which is, one of the reasons I like the alternative managers. To your question on fundraising, it has held up more so in some areas. So private debt is doing well. Private debt is often used as the financing behind private equity deals. And crucially here, lending is done at floating rate. And so you're seeing better returns as interest rates have moved higher so quickly. It's also higher up the capital stack relative to equity. And so it should be more defensive in any sort of downturn because you've got that, superior place in the capital stack. Private equity has been a bit more mixed. So certainly last year, there was what was called the denominator effect. So private market valuations had held up better than public markets. So that meant naturally institutions' allocations had increased to private equity, and then institutions weren't willing to increase that further. And this year you've seen M&A slowing down as well. So deal flow has been that much weaker. And so there's just been less recycling of capital. So private equity managers being able to sell assets and then, recycle that capital to support future fundraising. So it's a little bit more of a mixed message in private equity, but still holding up quite nicely in private debt.
That's great. Thank you very much, Will. And thank you to Richard for both of your insights and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button, and we'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. And finally, if you have any questions you'd like to ask one of our experts, simply ask them via our weekly comments page on our website. We'd love to hear from you. And that's it from today. So thank you, Richard, and to Will for your time, and to all of you for listening. See you next time.